In this module, we will try to learn about a financial market. We would also learn about the differentiation between different types of financial markets. We would understand about the investors in financial markets, be familiar with the characteristics of financial markets, and you shall also be able to learn other basic concepts used in a financial market. Learning about financial markets is useful. It equips us with the knowledge about how these markets work. Since all of us in one way or the other handles money, we have to take many decisions as to where and how we should invest our savings. We may have different options, for example, to invest in equity or debentures or fixed deposits, etc. Similarly, as a producer or a firm, we might be faced with the situation of raising money for our firm. So, the firm would be interested to know the cheapest and safest option available to it. The understanding of financial markets may help us to take an informed decision in all such situations. So, what is a financial market? A financial market is a market which helps the funds move from those who have a surplus, usually the household sector, to those who have a shortage, usually the business houses. A financial market is a market in which people and entities can trade financial securities, commodities, and other fungible items of value at low transaction costs and at prices that reflect supply and demand. Securities include stocks and bonds, and commodities includes precious metals or agricultural goods. Let us understand the difference between financial markets, capital markets, and stock markets. Financial markets essentially includes whole gamut of markets like stock markets, money markets, bond markets, etc. Whereas capital market on the other hand is just a subset of financial market. Capital market deals with securities which have a maturity of over 1 year and includes long-term government securities, corporate bonds, municipal bonds, corporate stocks, debentures, etc. Stock market only deals with the stocks, and bonds is a further subset of capital market. So, these are the distinctions between different markets. Let us know what are the types of investors in financial markets. A market participant may either be coming from the supply side, hence supplying excess money in the form of investments in favor of the demand side, which is coming from the demand side, hence demanding excess money in the form of borrowed equity in favor of the supply side. The main investors in financial market include public shareholders, financial institutions like it could be UTI, LIC, etc., or maybe foreign institutional investors, mutual funds, pension funds, private corporate bodies, promoters of corporates, their friends and relatives, NRIs. Public shareholders are often called by the name retail investors. So, we have different kinds of investors which may approach the financial market. Let us understand the stock markets first. There is a difference between risk tolerance and loss tolerance. So, let us understand it in section 5.1. To understand the difference between the two, let us assume that Mr. A is investing with risk tolerance of 15%. That means Ms. A should stay invested even if her portfolio falls by 15%. Then we may see, however, in practice when the portfolio of Mrs. A fell by 7%, he decided to close her account. Thus, when her portfolio started declining, he was not willing to take on loss more than 7%. This is known as loss tolerance. What is the difference between pure risk and speculative risk? In case of pure risk, there is only a possibility of loss or no loss, which means with no chance of gain. But in case of speculative risk, there is a chance of gain or loss. The example of the former includes risk due to earthquake, while the latter includes gambling. The second difference we would like to understand is trading versus gambling. What is gambling? In most gambles, the most popular being a casino, the possibility of your winning against a casino is very small. However, if you win, the payouts are extremely high. Also in gambling, one plays with the intention of trying out their luck. You do not buy a stock to try your luck. One common thing between the two, and that is outcome. Outcome is uncertain in both. Both means both in trading as well as gambling. What is the difference between trader versus an investor? Is every trader an investor? Let us understand this. If Mr. A buys a share of X company at rupees 50 today and sells it at rupees 75 after 1 year, one would think that Mr. A is an investor. However, it is quite possible that Mr. A might have been going through the pink pages daily or is hooked to his broker to look for the right opportunity to sell. So even though the actual sale might take place after 1 year, in such a case, Mr. A is a trader. So Mr. A is a trader, then who is an investor? An investor is a long-term buyer and is normally interested in dividend income. Such an investor is least worried about decline in the stock prices of the shares he is holding. On the contrary, an investor would buy more of the stock he or she is holding if that stock declines. So then both investors and traders have different perceptions of risk. The risk to an investor would simply mean wrong selection of the securities, while for a trader risk is generally related to price movement of the stock on the stock exchange. The entry and exit points are more important to a trader than an investor. Investor by default. It is also important to know the distinction between investor and investor by default. Sometimes when one trading decision pertaining to any stock goes incorrect, here again we may have a relook at our investor A, one wants to become an investor to the extent of that stock. So let us understand the stock markets. The discussion is around the bulls and bears in the stock markets. In common language, a bull would be associated with a rising market while the bear denotes a falling market. The most widely quoted definition of a bear market is that when a market declines by over 20% from a recent peak. Moreover, this weakness should persist for at least 2 months. That is a very common definition of a bear market. So what are the characteristics of a bear market or bear markets? Why it occurs? First of all, that is the important thing. The news flows tend to be worse than expected, causing the investor to sharply punish the stocks or sectors. Now what happens in such markets? In a bear market, the liquidity, which means the ease of converting securities into cash, is extremely tight. The volumes or the business traded is low, and the market breadth, which is nothing but advanced decline ratio, is poor. Every bear market, there are bear market rallies or pullbacks where the market rises 10 to 15% only to decline again. So which means the market may decline, may recover, and then again may decline. The bounce back occurs when some of the stocks or sectors are oversold. The bear markets are dreaded throughout the world. Everybody is scared or fearful of them. The bear market of 2001 to 2002 in US saw its indices shed more than half of its value. Similarly, the Great Depression in 1930s saw Dow Jones Industrial Average, which is DJIA, nosedive by nearly 90%. So historically, bear markets usually precede the great bull run in markets. A market enters a bull phase when the sentiment turns buoyant, which is the result of series of positive developments that beat the expectations of the market. Let us understand the stock recommendation and its interpretations. Mainly, stock market research analysis usually give a target price of the stock. Now this is a signal to the investor that when the stock hits that particular price, the investor can proceed with their analyst's recommendation. Now some of their recommendations and what they mean to an investor are as follows. First, buy recommendation. A buy recommendation basically shows that the stock is worth buying at its current price. The second recommendation is buy on declines. This recommendation shows that the stock is temporarily overpriced but is otherwise fundamentally good, and the investor can invest in this stock when its price falls. The third recommendation generally is long-term buy. This buy recommendation is based upon time horizons, showing that the investor must stay committed for considerably long periods, which may last 1 year or more. Let us understand the few more stock recommendations. Another recommendation could be strong buy. Now this shows that the valuations are extremely attractive and the analyst expects high degree of bullishness in the stock from its current price. Another common recommendation could be outperformer. This shows that the stock will perform better than this market index or any other benchmark. Basically, analysts are bullish on this stock. Another important recommendation could be overweight. Many investors keep not just single stock but a portfolio of stocks, and hence this recommendation is for them. An overweight recommendation on a stock means that the investor can increase the weight of that stock in his portfolio, which means you can buy more and keep in your portfolio. Another recommendation is of hold. Here is the belief that the stock may not appreciate significantly from the current levels in near future. However, its fundamentals have not deteriorated so much that the investor should exit from it. So if you already have that stock, you can continue to have or hold that particular stock. Another common recommendation is sell or dispose or substandard or underweight. All of these mean the same thing. A sell recommendation shows that the stock is fundamentally overvalued at its current levels, and the investor would be better off if he or she were to exit from it, which means if you sell it, that will be better. That is a kind of a recommendation when it is of sell. What is the linkage or the importance of the stock market? Let us understand it. The economy and the stock market linkages. There is a strong relation between the economic activity and the mood on the stock markets. When the economy is booming, which means it is going up, economic activity is at its peak. There is all-round excitement. Companies also announce big expansion plans, and their valuations reach new highs. The investor too keeps on pouring money into the markets and tries to shop for stocks as though there is no tomorrow, which means they are also very optimistic. This continues till somewhere down the line some company steps out of the line, which means it fails to meet its overstretched goals and the tumble starts. Now if the company too its front fails or if the economy too on its front fails to meet some of its macro targets like GDP target or inflation target, etc., this is a signal of the slowdown, and this continues for some time, and the economy slips slowly into a recession. The mood on the stock market too in this case changes, and the fear grips the market as the economy goes bust. After a time, slowly but surely, economy begins to recover as someone had realized that things cannot get any worse. So which means you almost reach the bottom, and therefore there could be a sense of some kind of optimism or recovery. Then there is also some improvement on the macroeconomic parameters. The mood on the stock market turns from pessimism to caution, and if the economy shows further signs of improvement, the excitement on the stock market returns, and this cycle goes on. So you may have optimism to pessimism, and similarly from pessimism to optimism. The question therefore is, are Indian markets integrated with the world markets? Meaning thereby, are we affected, or the Indian markets or Indian stock markets are affected by the happenings in the world markets? It is observed that till early 1990s, the Indian markets, they moved up and down almost entirely on their own, taking very little clues from the outside world. So maybe they were isolated. However, all that changed after the boom in the IT sector in the late 90s. Today, the situation is that any important international event has a deterministic role in the movement of Indian markets, even if India may not be a party to such an event. So what we are trying to say is maybe things have changed and we are relatively more integrated. On many occasions, these international events have overtaken the important domestic events in deciding the direction of the market, and therefore we may say that international events are more important sometimes than the domestic events. Let us now in the next section 8 understand the global Q and the concept of coupling. Global Q is a way of explaining the positive and negative effect of events in other markets on Indian stocks, which means all other markets except the Indian market. The reason for this is already stated above, where we have said that first, integration of Indian markets in recent years with international markets, and second, due to emergence of the large class of financial institutions and funds that frequently switch money from stocks, bonds and currencies across the world and thus play a key role in market movements throughout the world. So what is happening is very many large financial institutions, they move money from one place to another place wherever they find there are more returns. The question which we are raising now is there a need for integration or in a way comparison with other markets? Now some analysts have questioned the need for comparison between Indian markets and the world markets, especially US. This is so because Indian economy even today is a closed economy, as only 10% of its GDP comes from exports, and hence domestic issues, for example domestic demand scenario, are far more important than international issues. So if our integration is only up to 10% because of trade, we are saying maybe domestic issues are more important. Secondly, also the contribution of equity markets to industry resources is also not very high as compared to international markets. Further, one cannot expect the sectors which make up market index in one country shall be the same as in other markets. So there may be differences in these indices. So then different countries have different economic policies, business cycles, and they may not affect each other so drastically. Some analysts are therefore openly advocating decoupling of Indian markets with most developed markets. Now this would also mean that markets like India will continue to thrive even if developed markets like US were to enter into a recession. On the other hand, most of the emerging economies in Asia are closely coupled due to similarity displayed in terms of shareholder patterns, especially the retail or small shareholder whose behavior is alike in these markets. Now contribution of different sectors to the economy, the movement on inflation, real rates, growth rates, foreign exchange reserves, etc., all these are also similar in some of these Asian emerging economies. So let us try to understand in this section 7.2 the impact of two recent financial crises on world markets. The two recent financial crises have been, one, the dot-com bubble burst, and second, the subprime crisis which happened in US initially. The dot-com crisis, let us understand it first. World markets, they fell after the burst of the dot-com bubble in 2000. Dot-com bubble burst happened as stock markets had started valuing the IT stocks at very high price earning multiples, which we also define as high PEs. And these levels due to excellent growth rates of some of these companies. A time came when the markets realized that the valuation of IT stocks had been overstressed, and when the companies too failed to deliver the growth rates as promised, the crisis occurred. The second crisis, the subprime crisis, they occurred basically, and it is stated that when riskier loans were given, as the demand for such loans rose due to boom conditions in real estate, which means loans were given to subprime borrowers, which means borrowers who were not so healthy in their balance sheet. So the loans were given on the assumption that the issuer of these loans, which means the investment banks, could securitize these and sell these without much effort, and thus could transfer risk which they had taken while giving the loan. So they thought that this risk they can transfer to somebody else. However, when the property prices crashed, these borrowers started defaulting, resulting in the crisis. So what is the lesson for India? How was the Indian economy, or how was India affected? So although subprime crisis originated in the West and had no direct impact on India, still Indian stock markets reacted and fell much more than their counterparts in the developed world. If we compare the two crises, we find one common thing, and that is that before the crisis actually occurred, almost everybody starts believing the underlying mantra. For example, during the tech bubble, the mantra was that the sky is the limit for the IT stocks, and during the subprime crisis of 2008, the mantra was national house prices never fall. So these were the two mantras which were common. Let us now try to summarize what we have learned in this module. What we have learned is about the financial market, different types of financial markets, investors in financial markets, characteristics of financial markets, and some other basic concepts used in a financial market.